Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu. On today's show, we welcome Daniel Ameduri, who's the president of Future Money Trends. Welcome to the show, Daniel.
Thanks for having me on the show.
Let's start by going over the gold market today. Is the financial situation globally, from a macro perspective, in a state where the only outcome left for the average investor is to buy and hold traditional safe haven assets like gold and silver? And because of this, does it look like to you that we are now perhaps ready to begin another leg higher for gold after such a long bear market?
It certainly does look that way, that we're headed towards another move higher. Although I will say this, I've called up several of the major bullion dealers. They are not seeing much of an increase in demand on the retail side. On the junior mining side, same thing. You're seeing the producers move, the higher quality ones, but you're not seeing that rising tide lift all boats. They're not all just running. And we have had a fairly decent move here. So I wouldn't be surprised if we dip back into the 1400s for a little bit. And then, resume a brand new bull market in gold this fall and winter. So I suspect that we are in for some fairly good markets for precious metal investors, especially after this bear market, just because the CEOs are so conservative. A lot of them are still cashed up from money they raised in 2016, at least the higher quality ones are. And you're not seeing them have any trouble raising money. It's funny, the cannabis guys are having trouble raising money right now. But some of the higher quality gold projects, I've seen some recently that are oversubscribed by 60%. So I think we're definitely there. The smart money is getting in. The institutional money is getting in. The retail guy hasn't even touched it. So there's plenty of room. And plenty of runway. And I personally think gold will probably go to around $2,000 this year. I don't even think it's gonna take that long because of what's happening globally with the interest rates.
Well, let's move on and talk about the junior mining stocks in more detail. The bear market in the precious metal space has left most investors underwater, and the risks when investing in an exploration stock within a bear market are clear. But what are the potential gains that could be made when a volatile sector transitions back into a bull market? The marijuana sector over the last few years, for example, has perhaps shown investors the types of gains that could be made when riding a new bull market.
Well, I mean, if you look at even the higher quality mid tiers, like a First Majestic, you've already seen a gain on the NYSE, the U.S. side. It's gone from $6 to $11, and that's just the party's just getting warmed up here. So you can imagine these more speculative ones, these juniors, you could see them go from 10 cents to $1 in a good bull market. So I think there's certainly more opportunity in the junior space, but you have to keep in mind that you have to be a very disciplined stock picker, and I would definitely recommend anybody who's listening to this. Seek good counsel and make sure you're investing in proven management teams, people who are on their second or third go around. It's one of the more speculative spaces in the entire investment world. And for the most part, there's a good chance you're going to lose money because if you think about it, there's no cash flow, there's no balance sheet, there's hope, there's the expectation that something could happen. But it's not necessarily. So these stocks, these junior mining companies, especially exploration companies, they're all fighting gravity. You've got constant selling from financiers, from early investors. So without volume, these stocks are dead. So I would just tell everybody, if you're going to invest in a junior mining stock, make sure they have good management, of course. Make sure they have the ability to raise capital. Make sure they have a good asset. But then you also want to make sure they have great marketing, because without volume, these stocks are pretty much dead in the water, or they're just slowly sinking down.
I know you have a book coming out, Daniel, and at the beginning of your book, you talk about how you rode the housing bubble and then nearly lost it all. So can you talk about that and tell us perhaps why that experience helped you to become a better investor? Most highly successful investors within their career usually go through at least one period of nearly losing everything before they become financially independent. So can you talk about this period with us?
Yeah, the book is called Don't Save for Retirement. It's published on August 20th. Your readers actually are able to read the first chapter in the intro for free. It's where my wife and I are starting in a bankruptcy attorney's office. That's where the story starts, or the book starts. And they can go to futuremoneytrends.com/save, futuremoneytrends.com/save. And, when I went through the housing crisis and the bubble, I bought my first property when I was age 18. And of course, I had no clue that I was buying into what would ultimately become one of the biggest bubbles in housing history. And of course, I got over leveraged, I got greedy. And through the fire of that and the scars of that, it actually made me a better investor in the future because I did not involve myself in highly leveraged investments. I didn't overextend myself. I wanted to make sure I was more capitalized. And so it ultimately did make me a much better investor. And the second go around, I have a much cleaner balance sheet as I built up my passive income and ultimately became financially independent. But it actually closely ties in for anybody who's investing in the junior mining companies. Look, these mining CEOs who went through the 2008 crisis or most recently went through from 2012 to 2015, that is a deep scar in their mind. So if they've been through that, I guarantee you, that's what makes me a little more optimistic about this bull market is that these people are not overspending. They've got their costs down. They have the mindset of, hey, this is not just going to be straight up, because you can only imagine the guys who started their career in 2000 and then what was their mindset in 2011. So they had just seen straight up essentially. So I think for either investors who are looking to partner with other people, or me personally, when in this book, when I tell that story, is ultimately failure and disaster can be the greatest gift that can happen to you.
There's also a quote in the book which says, millionaires are frugal, price-conscious people. Now, I imagine most people never imagine millionaires to live like this, the usual stereotype of a lavish lifestyle and constantly spending money. So can you talk to us about this?
Yeah, I mean, our exposure to millionaires in the media are in Hollywood, and those aren't even normal millionaires. Look, millionaires that are buying yachts or have their own private jets, that's a whole nother level. That's way beyond even the deca millionaire status. It's normally in 100 million plus category. The average millionaire, though, they've done a lot of studies. In fact, the Millionaire Next Door, they did a 20-year study on millionaires. Most millionaires, they're wearing the average sneakers that anybody else would wear. They're driving. They're not driving Bentleys. They're driving luxury cars, but they're not driving Bentleys. They live in sustainable situations as far as their housing, their expenses, what they do for a living, what they do for work. And, the idea that everybody's, trying to get to where the puff daddy status is absurd. And it's not even something I think a lot of those people are happy with once they get there. So I would just say, in the book, we talk about setting up a sustainable lifestyle through expenses, and then setting it up so that you have your passive income pays for your lifestyle. And that really ultimately that wealth and control of your time is the objective that I think is worth pursuing.
You have been in the resource sector for many years, Daniel. So could you share with us perhaps some authors that have helped achieve success for you, and who in the resource sector do you take advice from?
Well, I would say the people, because, all these projects and all these stories, you can get hyped up on any of them. They all have this blue sky potential, but ultimately you need to surround yourself with the people who have proven success. One thing I learned from Marin Katusa was that these geologists that make a discovery, they'll go on to make a second or third or fourth, but really it's only about 1 in 1,000 that actually do make the discoveries. But of course, that guy who makes one discovery, he can always get more checks to keep drilling. The guy who failed on his first go around, probably not so much. The people who I really look up to is I thoroughly enjoy listening to Rick Rule. Absolutely love Marin Katusa. I'm very close with Keith Neumeyer. And I also look up to Amir Adnani, who's probably only a year or two older than me. But I've been able to witness Amir Adnani grow his companies and do these acquisitions better than anybody I've ever seen. And with Keith, of course, he's also a rock star. He's on his third go around trying to build another $1 billion company. He's already done 2. And just watching these guys, and I'll tell you, they're so focused. And then when it comes to investing, I highly recommend everybody start with Rick Rule and Marin Katusa. Spend a few months listening to those guys and investing with them.
As we begin to wrap up, Daniel, is there anything else you wish to discuss? Perhaps we can touch on the uranium market. What's your view on the current outcome for Section 232? And should the current weakness within this sector be seen as a buying opportunity, in your view?
I'm not a uranium expert. I listen to these guys and some of them who are experts. And I've heard since I got into this market in 2009, that uranium was going to be, have a big move after Fukushima. It would take 3 to 5 years, 3 to 5 years. Well, here we are. We're now 8 years later, and I'm still hearing people say 3 to 5 years. What I do know is there is a supply and demand imbalance, and that what happened 2 months ago with the White House memo, it was an obvious overcorrection for some of these U.S. producers or U.S. ready producers. And so I think there's an opportunity to buy them. For the most part, if you're looking for a long-term investment, I hate to say it, but 3 to 5 years, you're probably pretty safe buying uranium right now. But right now, honestly, I'm more focused on the precious metals.
Excellent. Okay. Thank you very much for your time today, Daniel. Much appreciated.
I appreciate it. And again, your subscribers, if they go to futuremoneytrends.com/save, they get the weekly wealth digest free, and they get to read the intro and the first chapter of the book. Thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?